SpotGamma.com.
Welcome to 30 Years of Options Education in 30 Minutes, presented by SpotGamma. This is a 3-part video series focused on options education for budding traders. In this video, we're going to hear from SpotGamma CEO Matt Fox as he walks us through a few foundational principles related to options. What are stocks? What are options? And what's the impact of trading volume? And why should options even matter to you in the first place? With that, over to Matt.
Welcome to SpotGamma's Introduction to Equity Trading video. My name is Matt Fox, and along with our lead innovator Brent Kachuba, I am a co-founder of SpotGamma. Let's take Apple as an example. Let's assume you bought the new iPhone 12 and think its features are really impressive. So using a brokerage account, such as Schwab or Robinhood, you decide to buy 10 shares of Apple, which requires you to spend $1,150 on their stock, $115 times 10 shares. Next, let's assume that over the course of the following 2 months, that Apple management provides updated guidance that they have seen increasing demand for the iPhone 12, and their sales have exceeded expectations. As a result, Apple stock goes up to $125 per share. As an investor, you can then make the decision to sell the stock at $125, returning roughly $100 of profit, 10 shares times $10. Keep in mind, if the opposite were to happen, where the stock would decline in value, you would be losing $10 per share on every dollar of stock price Apple goes down. Again, purchasing a stock results in risk, and you are investing with an expectation a stock will appreciate in value. Having just described what it means to buy a stock you believe will go up, and then sell that same stock to close out a position, we will now describe the opposite, how to short sell a stock when you believe a stock will go down. The act of short selling may seem confusing, but for the investor, it really is straightforward. Instead of buying a stock you don't own when you make a traditional investment, you sell a stock you don't actually own. Mechanically, this works because your trading platform or a bank will technically lend you the stock to go sell in the open market, with the promise you will buy back the stock in the open market later and return to the bank to close out the trade. As an example, let's again take the Apple stock price at $115. In this case, let's assume you believe the new launch of the iPhone 12 will be a flop because Samsung has a competitive product that is far superior to Apple. So you short 10 shares at $115. Next, let's assume that over the course of the following 2 months, that Apple management provides updated guidance that they have seen decreasing demand for the iPhone 12, and their sales have failed to meet expectations. As a result, Apple stock goes down to $105 per share. As an investor, you can then make the decision to buy back the stock at $105, returning roughly $100 of profit, 10 shares times $10. Keep in mind, if the opposite were to happen, where the stock would increase in value, you would be losing $10 per share on every dollar of stock price Apple goes up. Again, short selling a stock results in risk, and you are investing with an expectation a stock will decline in value. Having covered some of the basics around stock buying and short selling, we will now describe the participants. When you buy or sell a stock, you are often not trading with someone like you on the other side who just happens to have the opposite opinion. Instead, there are financial institutions which stand ready to buy and sell stocks and options. These groups are called market makers. Market makers can be very large banks or independent trading companies that are licensed by an exchange and make money by taking a small amount of every trade. They receive some preferential order treatment in exchange for being required to post a bid, an offer to buy, and ask, an offer to sell, in every stock where they are a market maker of record. Importantly, when they take a position on a trade, they need to protect their position because they are not in the business of making directional bets. They are in the business of getting paid for helping others take directional bets. So, to protect their underlying stock position, they trade options. SpotGamma has world-class expertise in analyzing the relationship between the amount of options it needs to trade in a given scenario in these derivatives markets and their effect on the way a stock may move. We will now continue our discussion with a description of options, calls and puts, and how they reflect an investor's interest in a company relative to a traditional stock. An option may seem like a very confusing concept, but simply stated, it is a way to invest in the outcome of a company by trading contracts that mirror the stock. We will now cover the basics of how this works. For the purposes of our discussion and in preparing you for more in-depth discussions around Gamma, we need to review the 4 main characteristics of options. 1. Options have a multiplier effect which produces leverage. 2. Options cost money to buy, and those who sell options receive the payment. 3. Options have a price at which you can buy or sell the underlying stock, which is known as the strike price. 4. Options have a time value from the date of purchase to when they expire. To take these in order, first, let's discuss leverage. In terms of listed options, one contract is equal to 100 shares of stock. This means that buying options contracts gives you the ability to have outsized returns if you are right. However, if wrong, you can lose the entirety of what you spent buying the contract. This can produce a defined risk metric that is not available in stocks, as your risk is limited to what you spend on the contract. Secondly, let's discuss the cost of the option. The cost of options have long been valued by calculus equations, including the Black-Scholes method. For our purposes here, what you need to know is that the price of a contract is listed as a bid offer on an exchange, just as prices are with stocks. Third, there is a strike price. This is the price at which you can later execute the option and own the stock. For a call option, if the stock is trading below the strike price, then there is little reason one would execute the option and accept the stock at that higher price. If the stock is trading above the strike price, then the holder of the contract may either 1. Convert the option into stock and then sell the stock at the higher price, or 2. Simply sell the option itself. Lastly, the options have a time value. Most options effectively expire at the close of trading on the third Friday of the month. However, importantly, now many stocks and indices trade options that expire either weekly or even a few times each week. The longer the time to expiration, the higher the cost, because it gives you more time for the stock to reach your price target. In terms of options, there are two types, calls and puts. We will start by describing an example using call options. A call option is the right to buy a stock at a future price up until a future date. Moving into our example here, let's assume that you believe that the new iPhone 12 will be a big success and Apple stock will go up in the next 3 months. If you decide to buy options, you would pull up your broker's website and see a range of strike prices and expirations. Let's assume you choose to buy the $115 March 19, 2021 call option for $4.50. Let's take a minute and break this down by going through the 4 categories we covered on the last slide. First, let's discuss leverage. In this case, you are buying one contract which represents 100 shares. The second important number is the cost. One contract, which represents 100 shares, would cost you $450. Buying 100 shares outright of Apple stock at $115 would cost you $11,500 of outlay. So the option gives you the chance to outlay less money and have a larger return if the stock price rises. The third important factor is the strike price. Here it is $115. You'd either execute the option by converting it into stock if the stock is above $115, and you would not if the stock is below $115 by the time the option expires. The fourth important factor is the time value. Here it is listed as March 19th, the third Friday of March. Between now and then, you will have the right to buy the stock at $115 or to sell the option for its price at any time. So, in the event that the stock increases to $125, you would be able to convert the stock, sell it for the $10 profit minus your $450 cost, results in $5.50 profit per share, times 100 shares is $550 in total profit. This is much larger than the example where you bought 10 shares of stock for $1,050 and made $100 in profit. So in summary, buying a call option gives you the ability to make a leveraged return. However, it comes with the risk that you can lose your entire investment. Now, we will cover the opposite of a call option, which is a put option. A put option is the right to short sell a stock at a price up until a future date. Said another way, a put option is a bet that the stock will decline in price. So here, assume you believe Apple stock will decline and you buy one Apple $115 March 19, 2021 put for $4.50. Again, let's go through the same 4 categories. First, regarding leverage, we are paying for the right to short sell 100 shares of Apple because we bought one contract. The cost here is the same as with the call option example. Since one contract represents 100 shares and costs $4.50, you are paying $450. Again, the strike price is $115. So if the stock is below $115, you would execute the option at $115 and buy back the stock lower for the profit. Lastly, again, regarding time, The option expires on the same date of March 19, 2021. So in the event that the stock decreases to $105 per share, you would be able to convert the stock, buy it back for $105, giving you $10 in profit, minus your $4.50 cost, gives you $5.50 of profit per share, times 100 shares is $550 in total profit. So in summary, buying a put option gives you the ability to make a leveraged return to the downside. However, it comes with the risk that you can lose your entire investment. We will now discuss one more topic related to options, selling them. Market makers and sophisticated investors often sell options for one of two reasons. The first is they believe that the option itself outright will generate a return. This is because they think the stock will not reach the price at which the option is struck. Therefore, the value goes to zero. In other words, in this case, they sell an option to generate income. In the Apple examples, if the other side of the trade is selling you the one contract of Apple $115 call options, dated March 19, 2021, they are hoping the stock stays below $115 and they can collect and keep the $450 that you've paid. The other reason, and the one we care most about at Spot Gamma, is to understand the amount of options trading due to people protecting their stock positions, again, called hedging. You can trade electronically through your trading platform or through a broker-dealer if it's a larger trade. However, we need to take a moment to explain that the amount of volume trading in the options markets far exceeds the amount of volume trading in the regular equity markets. This dynamic, which has only increased in size and disproportion over the last few years, gives even more confidence to Spot Gamma that our methods for analyzing options volume has important implications for the way that stocks trade. Spot Gamma takes all of these trades into consideration and provides its users with levels where we believe all buyers and sellers will trade.
In the next video, we will be covering hedging and how Gamma can be used to forecast market movement.